Hello friends, at the outset I would like to wish you and your dear ones a prosperous and a rewarding new year. It's my pleasure to share with you Aditya Birla Sun Life AMC Limited's Annual Investment Outlook 2024. As we look forward into this year, the picture looks much brighter as some of the concerns which dominated headlines in better part of 2023 such as US recession, stubborn inflation, rate hikes, USD strength, geopolitical risks have at the margin receded or no longer relevant. Global macro backdrop has turned supportive. Interest rate cycle has peaked out and we are expecting beginning of a rate easing cycle across most economies. We expect a soft landing in the US and slowdown in global growth, but not an outright global recession. This will be a year when more than 60% of the world population will go for elections, and therefore major fiscal consolidation looks unlikely on a global scale. The macro outlook for India also looks to be enjoying a Goldilocks kind of a scenario with reasonable growth momentum, stable commodity prices, especially crude, slowing inflation and a weakening dollar bias. We expect India's GDP to grow at the rate of 6.5% in FY25, primarily led by investments given the government's capex push and the revival in private capex and the housing sector. Consumption, which has been weak so far, should also improve from the current low levels on the back of general economic uptick, election-related spending and lower inflation. All these factors gives us greater confidence in the long-term sustainability growth of our economy despite some global headwinds. And India is set to become the third largest economy in the next 5 years. For an emerging market like India, it has exhibited great macroeconomic stability, which is reflected in the fact that last year, the volatility in our currency, INR, and bond yields was one of the lowest compared to other developed as well as emerging markets. This can make a case for lower risk premium for Indian markets going forward. The confluence of strong liquidity flows from domestic investors and FIs will ensure that Indian equity markets continue to remain at a significant premium to the other emerging markets. Last year, we witnessed large macro sectoral themes play out like realty, capital goods, PSUs, which gave outsized returns compared to the Nifty. In 2020-24, the macro trends will have less influence and the market breadth can narrow down, which means that bottom-up stock picking will play an important role for generating alpha and some consolidation of our portfolio holdings will be necessary. With interest rates expected to decline, from an investment style perspective, growth and quality at a reasonable price could now start to outperform value. Post-COVID, we have seen an improving corporate profit to GDP ratio and corporate earnings growth has been strong in the high teens. However, as the base effect of efficiency gains plateau, earnings growth over the next 3 years should track marginally above the nominal GDP growth, which is likely to be in the low teens. Earnings growth should be broad-based across sectors with banking and financials, auto, industrials, capital goods, cement, real estate sectors leading from the front. The key themes of interest for us going forward are banking and financials, domestic manufacturing and capex recovery, discretionary consumption, and digital. Given the valuations are slight premium to the long-term averages, we expect moderate returns from equity in this calendar year, possibly in line with the overall earnings growth. We would also be more inclined towards large caps over mid caps and small caps, considering that their relative valuation differential is at an historical high levels. Equity still remains the best asset class from a long-term perspective, given the strong foundation of India's growth-led structural reforms, and SIP would be the best way to participate in this journey. On fixed income too, our view is constructive as real rates are at elevated levels with expectation of fiscal consolidation and global bond index related flows helping. Capital gains are likely even as accrual returns should stay elevated. Active management will be the theme to capture opportunities on duration and credit. Hence, besides asset diversification reasons, one can increase allocation to fixed income from a tactical allocation. Decline in real yields, USD weakening, and continuing geopolitical risk premium should also be supportive for gold. Overall, risk reward across various asset classes seems to be well balanced. Hence, for the coming year, we advise a multi-asset allocation approach with the right exposure to equity, fixed income, and gold. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।